Have you ever seen those videos where someone pulls out their phone, opens their brokerage app, and shows you a deposit that just landed in their account? They didn't sell anything, they didn't work for it, it just showed up. And the caption is always something like, "Another day, another passive income deposit." And you're sitting there watching it thinking, wait, how do I get that? I get it. That feeling is real. And that is exactly why dividend investing has become one of the most talked about strategies in personal finance right now. But here's what those videos never show you. They never show you what that same portfolio looks like 30 years later compared to someone who did something completely different. Something so boring, nobody makes videos about it. Because when you actually run that comparison, the results are not close. Welcome to Habibi Finance. Today we're breaking down dividends versus index funds. The real math, the tax situation that almost nobody talks about, what retirement actually looks like with each strategy, and which one genuinely builds more wealth over the long run. Let's get into it. Quick disclaimer first, nothing in this video is financial advice. Always do your own research. Okay, now we're good. So let's start with dividends. And I want to be fair here because dividends are actually a really elegant concept when you understand them properly. When a big established company makes more profit than it can efficiently reinvest back into the business, it has a few options. It can buy back its own stock, it can save it, or it can just send that cash directly to its shareholders. That cash payment is the dividend, and the companies that pay them tend to be the boring giants, not the exciting startups chasing the next big thing. We're talking about the companies your grandparents recognized, consumer brands, utility companies, banks, businesses so stable and so profitable, they've essentially become cash machines. There's even a special group called dividend aristocrats. These are companies that have raised their dividend every single year for at least 25 years in a row, through recessions, through crashes, through a global pandemic. They just kept writing bigger checks. And when you hear that, it genuinely sounds like the safest, most reliable investment in the world. But here's where I need to pause and show you something important. When a company pays you a dividend, the stock price drops by almost exactly that same amount on the same day. Sit with that for a second. You own a stock at $80, it pays you a $2 dividend. The next morning, it opens at $78. You have $2 in cash, you have $78 in stock, you had $80 worth of stock yesterday, you still have $80 total today. The dividend didn't create new money, the company moved value from the stock into your hand, left pocket to right pocket, and now you owe taxes on those $2. This is not a hot take, this is settled academic theory going back over 60 years. It's called dividend irrelevance, and it was proven mathematically by two economists in 1961. The passive income content just never leads with this part. Now, before you close the video, hear me out. Because I know what you're thinking. Okay, but if I reinvest those dividends, they compound over time and eventually snowball into something massive. That's true, they do compound. But here's the thing, so does everything else. The real question is not whether dividends compound. The question is whether dividends compound more efficiently than the alternative. And to answer that, we need to talk about the thing that almost nobody in this conversation ever brings up properly. Every dividend that lands in your account is taxable in the year it arrives, not when you spend it, not when you withdraw it from your portfolio. The moment the deposit hits, the government wants their share. Now, if you're holding quality dividend stocks long enough, you get taxed at the lower qualified dividend rate, 0, 15, or 20% depending on your income. That's the friendlier version. But here's where it gets more expensive. A lot of the high yield stuff people chase, the REITs and certain high yield ETFs with those attractive 7 and 8% yields, those pay what are called unqualified dividends, taxed at your full ordinary income rate, same bracket as your salary. And the part that really gets me, even if you reinvest every single dividend immediately, even if the money never touches your bank account, even if you never spend a single cent of it, you still owe taxes on it that year. The deposit went straight back into your portfolio, but April rolls around and there it is on your tax form like clockwork. That is a quiet tax bill running against your compounding every single year for as long as you hold those positions. And because your portfolio balance keeps going up anyway, most people never notice it's happening. Okay, so now the other side. Index funds. And look, I'll be honest, index funds are not exciting. There is no notification to screenshot. There is no quarterly deposit to post. Nobody is going viral showing off their index fund balance. But let's talk about what they actually are. An index fund is a fund that tracks a market index. The most common one is the S&P 500. 500 of the biggest companies in America bundled into one single investment. When you buy it, you instantly own tiny pieces of hundreds of companies across every major industry all at once. The whole philosophy was basically pioneered by a man named John Bogle who founded Vanguard in the 70s. His argument was devastatingly simple. Most professional fund managers fail to consistently beat the market over time. So instead of paying someone to try and mostly fail, just own the whole market for almost nothing. Guarantee yourself the market return and let decades of compounding do the heavy lifting. The data has supported him so strongly it's almost uncomfortable. Studies consistently show around 90% of actively managed funds underperform their benchmark index over 15-year periods. 90% of the professionals lose to doing nothing. The fees on index funds are almost laughably small. Some charge 0.03% per year, and because they barely trade throughout the year, they generate almost no taxable events, which means you are in control of when you pay taxes. You sell when it makes sense for you, not because a company decided to send you a check this quarter. All right, let's put real numbers on this because this is where everything gets clear. Two people, Layla and Omar, both 28 years old, both earning 70,000 a year, both going to invest $800 every single month for 30 years in a regular taxable brokerage account. Layla builds a dividend portfolio. She does proper research, picks solid dividend paying companies and ETFs, gets her average yield to around 4%, and sets up automatic dividend reinvestment. Every quarter deposits hit her account, and it genuinely feels incredible. Omar does something almost embarrassingly simple. He picks one index fund tracking the S&P 500, sets up an automatic monthly purchase for $800, and then basically gets on with his life. No yield tracking, no quarterly excitement, just one fund bought automatically every month. His friends think he is not taking investing seriously enough. Let's see what happens. Year 5, Layla is generating around $2,200 a year in dividends. Real money, real deposits. Omar has a slightly larger portfolio balance, but no income events at all. By every visible measure, Layla looks like she's winning and she feels like it too. Year 10, Layla is at around $190,000. Omar is at around $215,000, a $25,000 gap. Layla doesn't notice because her own balance is growing and her dividends are bigger than ever. Everything feels like it's working perfectly. Year 20, Layla is at 460,000, Omar is at 565,000. The gap is now over $100,000. Layla still doesn't see it because she only ever compares herself to where she was last year, and that comparison always looks great. Year 30, Omar has $1.25 million. Layla has $1.02 million, a $230,000 difference. And Layla felt confident in her strategy the entire time. Her balance went up every year. Her dividends grew every year. Not a single signal ever told her something was off. Three forces ran underneath the whole time. First, the return gap. Dividend-focused portfolios have historically returned around 9% annually. The broad U.S. market has returned closer to 10%. 1% per year sounds tiny. Compounded over 30 years on consistent monthly contributions, it is not tiny. Second, tax drag. Every year, Layla received dividends. Every year, she paid taxes on them, whether she wanted to or not. Omar's index fund generated almost no taxable distributions throughout the year. That difference compounded in Omar's account for 3 decades, not Layla's. Small differences in expense ratios between Layla's dividend funds and Omar's index fund were barely visible in year one, but became real money over 30 years on a growing portfolio. Three quiet forces running every single month for 360 months. But here is where I need to be genuinely fair because index funds have a real problem. Omar cannot live off his portfolio without selling shares. And when you are young and investing, that sounds completely fine. But imagine you are 65, you just retired, and in your very first year out of work, the market drops 40%. Every single month, you have to sell beaten down shares just to pay your bills. That is called sequence of returns risk. It is real and it can seriously damage a retirement if the timing is bad. Selling at a loss in your early retirement years means that money is not there to recover when markets bounce back. Layla does not have this problem. Her dividends arrive whether markets are up or crashing. She does not sell a single share to cover her expenses. She just collects the deposits and waits for recovery. That is a genuinely meaningful advantage. And the psychology matters too. When markets crash and you are holding an index fund, there is nothing happening in your account, no deposit, no signal, just a scarier number on a screen and your own brain filling in the worst case scenario. That is when people panic sell. That is when people lock in losses it takes years to recover from. Dividend investors have a built-in quarterly reminder that something is still functioning. That psychological anchor keeps people invested through rough markets. And staying invested through rough markets is honestly most of what separates successful long-term investors from unsuccessful ones. Real advantages. Do not let anyone tell you they are not. Now, here is the retirement income comparison that I think is the most underrated part of this entire debate. Both Layla and Omar are 65, both need $45,000 a year to live comfortably. Layla's dividends are generating around $50,000 a year. She does not touch her principal. Cash arrives automatically. First instinct, Layla finally wins one. But those dividends are taxable the moment they land, some at the qualified rate and some at her full ordinary income rate, depending on what she holds. After federal taxes, her $50,000 in gross dividends might realistically become $43,000 to $45,000 in actual usable income. Omar sells shares to generate his $45,000, which sounds worse on the surface. But Omar controls exactly when he sells and exactly how much gain he realizes each year. And the 0% long-term capital gains bracket in 2026 applies to a meaningful level of gains for a typical retiree. Omar has held his fund for over 30 years. When he sells, a portion of every sale is just return of his original investment, not taxable gain at all. By managing his withdrawals thoughtfully, Omar can structure his retirement income to owe close to nothing in federal taxes. Same lifestyle, completely different tax outcome, and Omar still has 230,000 more in principal quietly compounding. The strategy that looked like the obvious winner in retirement did not actually win the retirement comparison. So here is the actual playbook, simple and honest. During your working years, build your core wealth in a low-cost index fund inside a taxable brokerage account. Keep fees low, let diversification work, maintain control over when you realize gains. This is where the math wins cleanly. If you love dividends and you want that cash flow feeling, put dividend stocks inside your Roth IRA. Inside a Roth, dividends are never taxed. The single biggest cost of the dividend strategy disappears completely. You keep the psychological benefit of income arriving while eliminating the drag. That combination actually makes a lot of sense. But please hear this clearly. Holding dividend stocks in a taxable brokerage account when you still have available Roth space is one of the most expensive and most avoidable mistakes in personal finance, and almost nobody talks about it. As you get within 5 to 10 years of retirement, start layering in more dividend exposure for income stability, not replacing your core portfolio, just adjusting the structure for a different season of your life. Here is what I want you to remember from this video. Dividends feel like the smart move, the passive income, the quarterly deposits, the proof that your money is out there working while you sleep. Index funds feel like giving up, like you are not even trying. But 30 years from now, the person who set up one automatic investment and got on with their life is sitting on $230,000 more than the person who spent 3 decades carefully managing a dividend portfolio. Not because dividends are bad, because three invisible forces, a small return gap, annual taxes you never asked for, and tiny fee differences ran quietly in the background every single month for 30 years. And compounding is absolutely ruthless with invisible things. The best investment strategy is not the one with the best story at a dinner table. It is the one that builds the most wealth while you are busy living your life. If this helped you see something differently today, hit the like button. It genuinely helps Habibi Finance reach more people. And drop a comment below telling me which strategy you are currently using and why. I read every single one. See you in the next video. Habibi.